You're tuned in to the deep dive. Today, we're really digging into something major, that huge shift in U.S. trade policy, the April 2025 tariff shockwave from the Trump administration.
Yeah, and it wasn't gradual at all, was it? It really just landed. Bam. Some are saying it's maybe the biggest trade policy shakeup in, what, a century?
Exactly, faster and broader than even what we saw during the first Trump term.
And it's crucial, I think, for listeners to get that this isn't just some abstract news story. These tariffs, they're already hitting investments, supply chains, company profits.
Right, and inflation, even recession risks, it's all connected.
Definitely. So this deep dive is really about making sense of it all, giving you that clear picture you need for, navigating what's happening.
Yeah, we're going to unpack what exactly went down in April. Then we'll look back a bit, see the historical context, the playbook maybe.
And then the fallout, right? The macro effects globally.
For sure. Global impact, sector by sector, who's winning, who's losing. We've got some company case studies too.
Okay, good. And the modeling.
Yeah.
How economists are trying to predict this.
Yeah. We'll touch on the quantitative models and then wrap up with what it all means for investors strategically. And honestly, the conclusion might offer a slightly different angle than you expect.
Intriguing. All right, let's jump in. Chapter 1. The April 2025 tariff shockwave. So what precisely happened in those first few days of April?
It was really a whirlwind, just bang, bang, bang announcements coming out super fast. And the core idea seems to be these reciprocal tariffs.
Reciprocal, right.
President Trump even called April 2nd Liberation Day. The framing was all about, leveling the playing field against countries the U.S. sees as having lower tariffs. It's a really broad approach.
And the legal justification they're using this time, that's quite different, isn't it? It signals a shift.
Absolutely. They're leaning heavily on IEPA, the International Emergency Economic Powers Act.
Okay. IEEPA.
Yeah, they've actually declared a national emergency. The argument is that these big, ongoing U.S. trade deficits, they're a threat. That's the emergency.
Now, that's interesting because, look back at the first term tariffs.
Right.
The justifications were different. We had Section 232, remember, a national security that was for steel, aluminum, the auto tariff threats, and then Section 301 aimed at what the U.S. called unfair practices, like China's IP issues.
Yeah.
But using IEPA, which gives the president these broad emergency powers, specifically for trade deficits, that's definitely new territory. Legal, it's already kicking up legal challenges.
It really sets the stage, doesn't it? Which brings us nicely into Chapter 2, looking back a bit at the historical background and policy rationale. Because, like you said, this didn't just come from nowhere.
Exactly. You can definitely see the echoes of 2017 to 2021, right? Tariffs were a big part of the toolkit back then, too.
For sure. Those Section 232 tariffs on steel, aluminum again, national security.
Yeah.
And the big Section 301 tariffs on China over IP and other things.
And the goal stated back then, what was the main narrative?
Mostly around, boosting U.S. manufacturing, bringing jobs back, shrinking that trade deficit. That was the consistent message.
And thinking back to how the markets reacted then, what do you recall? What jumped out?
Well, definitely uncertainty. Lots of it. Volatility ticked up. You had some domestic producers, maybe like U.S. Steel, who looked like they might benefit initially.
Right, protected from imports.
Yeah, but then pretty quickly you saw the downsides hitting industries that use that steel or aluminum, higher costs, and then the multinationals, complex supply chains, suddenly facing retaliation risks. It wasn't simple.
Which leads us straight into Chapter 3, the macroeconomic impacts. So these new April 2025 tariffs, what are the big picture effects expected globally?
Well, the general consensus from economists points to pretty significant disruptions. Global trade flows, the way goods move around the world, that gets changed fundamentally by big tariffs.
And supply chains. They must be feeling the strain.
Oh, absolutely. These incredibly complex global supply chains are under enormous pressure. Companies are having to rethink everything, maybe even restructure. Imagine, a product with parts from 10 countries. Suddenly, the cost of putting it all together just skyrockets.
Which brings up the obvious question, what about the U.S. economy itself? What's the likely hit to our own growth?
Most models are suggesting, a drag on growth. Tariffs, they basically act like a tax, right? On consumers, on businesses. Consumers might face higher prices, buy less. Businesses might hold off on investing because things are so uncertain, costs are up. both slow things down. And then there's inflation.
Right, the pass-through to prices.
Exactly. Tariffs raise the cost of imports. Do companies eat that cost? Squeezes their profits? Or do they pass it on? Pushes inflation up? It's a real risk.
And beyond just growth and inflation, what else gets affected? Currencies, sentiment.
Yeah, currency markets could definitely see shifts. Big trade policy changes can move exchange rates around. Maybe a flight to safety if the global outlook dims. And sentiment? Well, we saw that immediately, didn't we? Stock markets dropped sharply right after the April news. That tells you a lot about investor confidence, or lack thereof. Okay, let's get specific. Chapter 4, the sector deep dive. This is where we see how these big policies actually play out on the ground. Let's start with manufacturing and heavy industry. U.S. Steel, we mentioned them as maybe benefiting.
Yeah, but it's tricky, isn't it? Looking back historically, sure, a domestic steel producer like U.S. Steel might get an initial boost from, say, a 25% tariff cutting down imports.
Makes sense.
But that protection has knock-on effects. Think about the downstream industries, car companies, construction firms, they rely on steel. Suddenly their costs jump.
Right. Makes them less competitive.
Exactly. Could even reduce their own production, which ironically means less demand for domestic steel eventually. And if you look at U.S. Steel's actual numbers after the 2018 tariffs, it wasn't exactly a smooth ride to sustain profitability. Tariffs alone aren't a magic wand.
And then a company like Caterpillar. Global footprint, huge supply chains. How do they fare?
Yeah, companies like CCAT, they're really exposed. Very international supply chains, big sales overseas. They got hit with higher steel and aluminum costs last time, right? Hurt their margins. Plus, selling globally, especially in China, makes them a prime target for retaliatory tariffs from other countries. Remember, they had that profit miss Q4 2018, partly blamed on tariffs and uncertainty.
I do, yeah.
And the stock reacting negatively in April 2025 on fears of Chinese retaliation. It just highlights that ongoing risk. It's a tough spot.
Okay, let's switch gears. The automotive sector. What's the potential impact looking like there?
Well, there's talk of tiered tariffs on imported cars and parts. Could be anywhere from, 10% up to 25%.
Yeah.
That could send ripples through the whole industry.
Because everything's so interconnected.
Totally. Modern car manufacturing, parts cross borders multiple times before a car's even finished. And pretty much all the big OEMs, the manufacturers, they rely on these global chains. So, yeah, it's expected to hit almost everyone.
So higher prices for car buyers, production issues.
That's the worry. Higher prices, definitely, maybe production hiccups, and tough choices for the car makers about where they source parts, where they assemble. Big headaches.
No, the giant technology and electronics. This feels like ground zero for complex global supply chains.
Oh, absolutely. Some estimates are throwing around numbers like billions of dollars in extra costs per month for the tech industry from these tariffs.
Billions. Wow.
Yeah. Think about something like Apple's iPhone. Most of it made, or at least assembled, in China, right?
Yeah.
Using parts from all over. Analysts are predicting price hikes for consumers. Could be $100, could be way more. Some scenarios even suggested like doubling the price, depending on the tariff details and how Apple reacts.
That's staggering for consumers. So what can Apple or companies like them actually do?
It's a tough call. They can try to, absorb the tariff costs themselves, but that hits their profits, their stock price. Or they pass it on to us, the consumers. But then you risk demand just falling off a cliff, especially for pricey gadgets. We're already seeing analysts projecting hits to Apple's EPS, their earnings, depending on which way they go.
And operationally, moving production.
It's a massive challenge.
Yeah.
Companies were already trying to diversify away from just China, and these tariffs just turbocharge that.
Like Apple flying stuff in from India?
Exactly. We saw those reports using charter flights from India to build up U.S. inventory before the tariffs hit. Shows the scale of the scramble. But realistically, moving complex electronics manufacturing back to the U.S. quickly, most people think that's just not feasible near term. The infrastructure, the skilled labor, the cost, it's a huge barrier.
So uncertainty probably slows down investment too, like R&D.
You'd expect so. Why make big long-term bets when the rules keep changing? And for tech, there's another layer of risk beyond just tariffs.
Which is?
Retaliation from China that isn't tariffs. Think critical minerals. China dominates the supply of things like rare earths, gallium, germanium.
Essential for chips and electronics.
Absolutely essential. If China restricts exports of those, that could cause chaos in the global electronics supply chain, way beyond just tariff costs.
Okay, what about the chip companies themselves? The designers, NVIDIA, AMD, Qualcomm, they don't have their own factories mostly.
Right, the fabless model. Initially, that looked like a bit of an advantage. Because they outsourced manufacturing, mostly to places like TSMC in Taiwan, they weren't immediately hit by tariffs aimed specifically at goods made in China.
Their stocks held up better at first?
Yeah, relatively speaking. But, and it's a big but, they're still exposed. Those reciprocal tariffs could easily hit imports from Taiwan or other Asian hubs where their chips are made.
Ah, okay.
Plus, they face all the broader risks. Supply chain disruptions at TSMC, possible Chinese actions impacting TSMC, a general slowdown in global demand for electronics if tariffs bite the economy. They're not immune at all. We even saw AMD's stock diff later when Taiwan geopolitical tensions flared up again. Shows that vulnerability.
Let's pivot to agriculture. How are tariffs impacting that sector?
Well, our main sources don't go super deep on the specifics for ag in April 2025, but generally speaking, economic studies show tariffs from big economies can really hurt agricultural exports from developing nations, distorts trade, shifts demand.
And for U.S. farmers, retaliation is the big fear.
Retaliation is always the big fear for U.S. agriculture when tariffs fly. Other countries hit back where it hurts, and often that's things like soybeans, pork. It disrupts trade deals, hurts farm incomes. Definitely a major concern.
And then consumer goods and retail. This is where it hits Main Street, right?
Absolutely. Retailers, especially those selling non-essential stuff, discretionary goods, they could be in for a rough time.
Why specifically?
It's kind of a double whammy. You've got potential inflation from the tariffs making imports pricier, and at the same time, consumer confidence might weaken if people are worried about the economy. That combo. It can lead to people spending less, leaving retailers stuck with inventory they can't move.
And didn't we learn something about consumer behavior during the last round of tariffs, 2018-19, that the models weren't quite right?
Yeah, that was interesting. Some of the standard economic thinking didn't quite capture it. For instance, models maybe underestimated how sticky demand was for some basic things like cheap clothes, household stuff, even when prices went up.
People still needed them.
Right. But for other things, fancier clothes, electronics demand dropped off maybe faster than expected. And the idea that consumers would just seamlessly switch from imports to U.S.-made goods, that didn't really happen across the board.
Well, it did happen.
A lot of people just bought less stuff overall, responded to the higher prices and uncertainty by tightening their belts. That hurt retailers more broadly than just shifting sales from one product to another.
Okay, last one for this section. Energy and chemicals. Any initial read there?
Interestingly, the early reports suggested that a lot of chemicals were actually spared in the first wave of these new tariffs.
Oh, why might that be?
Could be several reasons. Maybe because chemical supply chains are so incredibly complex and integrated globally, slapping tariffs on them could cause massive disruption to U.S. manufacturing itself. But, that could easily change. Could be in the next round, or it could come via retaliation. It's definitely not set in stone.
All right, this is a good place to pause. When we return, we'll zoom in on some specific big-name companies and how they're trying to navigate these tariff challenges. Stay with us.
We want to tell you about a really cool tool that can help you, get these kinds of insights on your own whenever you need them.
Imagine this. You can generate a full report, like a detailed podcast or even a video analysis on any stock whenever you want.
And what if that analysis was tailored to you? Like, your level of financial knowledge, how deep you want to go in each area.
At stockanalytics.ai, we're not just imagining it, we're building it. We're creating a platform that lets you do all of that. And we're taking it even further. We're adding an interactive interface where you can ask specific questions about the stock, a voice-controlled stock screener to find your next great investment, and even a sophisticated portfolio analyzer that'll help you manage risk and stress test your holdings.
Don't wait. Go to stockanalytics.ai today and check out our demo. You can see the power of this technology firsthand. We've opened up our waiting list for beta users, and early adopters get 50% off. Plus, you might even get a chance to invest in the future of, financial intelligence.
Sign up now at stockanalytics.ai. You don't want to miss this.
Welcome back to the deep dive. We're now jumping into Chapter 5, focusing on high-profile stock case studies, seeing how these tariffs are really hitting specific companies. We touched on U.S. Steel and Caterpillar earlier. Let's quickly revisit them.
Sure. So for U.S. Steel, maybe some short-term benefit from less import competition.
But you've got the risk of a broader economic slowdown hitting overall steel demand. Plus, their own customers, the manufacturers using steel, are facing higher costs. It's a mixed bag.
And Caterpillar.
Still facing those two big headwinds, really. Higher costs for their materials, like steel and aluminum. And the big one, the risk of retaliatory tariffs hitting their sales all around the world. Investors are definitely watching that closely.
Okay, now for a giant Apple. We talked about their huge China exposure. How bad could this be?
It's potentially really significant. I mean,
Yeah.
estimates are like 80% of production capacity in China. That's massive exposure. The idea of big price hikes on the iPhone, their biggest moneymaker,
Yeah.
that's a serious threat.
And the market reaction showed that concern.
Oh, yeah. Apple stock dropped sharply right after the April tariff news. That tells you the level of investor anxiety. Now, Apple's been clever before, getting exemptions, and they are diversifying India, Vietnam.
But this time is different.
The scale seems much bigger this time. Broader tariffs, fewer obvious ways around them. It looks like a much tougher challenge than before.
But they do have that growing services division, right? Apps, music, does that help cushion the blow?
It definitely helps. Services revenue is high margin, growing fast, and not directly hit by tariffs on physical goods. So that's a positive buffer. Still, you hear analysts calling the tariff threat a potential gut punch.
Ouch. But others see a buying opportunity.
Yeah, some investors look past the immediate noise, figure Apple's brand is strong, they'll adapt, and maybe the stock dip is a chance to buy. So conflicting views out there.
All right, let's talk Intel. Their situation sounds uniquely tricky, tied into U.S. industrial policy.
Yeah, Intel's facing a weird twist. Reports suggest China's hitting back with tariffs based specifically on where the silicon wafers are made.
The actual chip fabrication location?
Exactly, which directly penalizes Intel's big strategy of building more advanced chip factories in the U.S. Chips made in those new U.S. fabs, if sold to China, get hit by these retaliatory tariffs.
So it puts them at a disadvantage
Against their fabless rivals, AMD, NVIDIA, these foundries elsewhere, mostly Taiwan. So Intel's U.S. expansion, and partly it boosting domestic supply, actually makes them more vulnerable to these specific Chinese tariffs in that market.
Wow. Talk about unintended consequences.
Right. The stock reacted negatively to that news. It really shows how trade policy and industrial policy can sometimes clash in unexpected ways.
And what about those fabless guys? NVIDIA, AMD, Qualcomm, they looked better initially, you said.
Yeah, they're model designing chips, outsourcing the making, mostly to TSMC in Taiwan, gave them some initial protection from tariffs aimed squarely at China. Stock prices reflected that.
They're not totally safe.
Definitely not. Still exposed to those potential reciprocal tariffs on goods coming from Taiwan or other Asian tech hubs. Plus, broader risks remain.
Yeah.
Any disruption at TSMC, other forms of Chinese retaliation may be hitting TSMC indirectly, or just a global slowdown hurting chip demand overall.
Right, the AMD stock dip later on showed that.
Exactly. The Taiwan geopolitical risk is always there in the background for them. It's a constant vulnerability.
Okay, moving into Chapter 6, quantitative modeling. How on earth do economists try to calculate the impact of all this complexity?
Well, they have some pretty sophisticated tools. One big one is computable general equilibrium models, CGE models.
CDE models. Okay.
Yeah, I think frameworks like GTAP institutions like the CBO, places like Trade Partnership Worldwide use these. They try to simulate the whole economy, basically.
Yeah.
All the connections between industries, labor, capital, trade flows.
Like a giant economic simulation?
Kind of, yeah. You feed in the tariff details, and the model estimates the impact on things like GDP growth, specific sectors, trade volumes, even income distribution.
Can they look short-term and long-term?
They can. Some are static, like a snapshot assuming things like capital stock are fixed. Others are dynamic, letting investment and other things adjust over time, giving a longer-run view. Then you also have macroeconomic models, like the one from Penn Wharton.
How are those different?
They tend to have more detail on how households and companies behave. Plus, they factor in things like government budgets, international money flows, good for longer-term projections of GDP, wages, investment, that kind of thing.
And then there's just looking at what actually happened in the past.
Exactly. Econometric studies. Researchers use historical data, statistical methods, fancy names like difference in differences or event studies to see the real-world effects of past tariffs.
Like, how much did prices actually go up for consumers? Or what happened to jobs?
Precisely. Institutions doing this work include Penn Wharton again, CBO, Tax Foundation, Peterson Institute, NBER researchers, Trade Partnership Worldwide. Lots of groups crunching numbers.
And what kind of data do these models need?
Oh, tons of data. Detailed trade stats, tariff schedules, national income accounts, input-output tables showing how industries buy from each other, and crucially, estimates of trade elasticities.
Elasticities, meaning how much trade changes when prices change.
Yeah, basically how sensitive trade volumes are to price shifts caused by tariffs. That's a key input.
So With all these complex models running,
Hmm.
what's the general picture emerging? What are they predicting for the April 2025 tariffs?
Well, obviously, the exact numbers vary between models depending on their assumptions.
Yeah.
But if you synthesize it, the broad consensus across most of these quantitative analyses is uh, generally negative for U.S. GDP growth.
Slower growth.
Yeah. Plus, an expectation of higher inflation pressures and significant disruptions to global trade patterns. The overall direction, negative for growth, positive for inflation, disruptive for trade that's pretty consistent across the board, even if the specific numbers differ.
Which brings us to the practical side. Chapter 7, Strategic Implications for Investors. Given all this, uncertainty, disruption, how should investors approach this?
Well, the key word really has to be risk management, doesn't it? With this much uncertainty and potential volatility, being careful is paramount. Diversification becomes even more important.
Spreading bets across different assets, different places.
Exactly. Across asset classes, across geographies, it helps cushion the blow if one specific sector or country gets hit really hard by these tariffs or, retaliation. Don't put all your eggs in one tariff-exposed basket.
Are there specific types of companies or strategies that might do better in this environment?
Well, you might look for companies that are less reliant on international trade overall, or businesses that have shown they're really good at adapting their supply chains quickly when things change. Agility is key.
So stay nimble, stay informed.
Absolutely. Keep a close eye on policy developments, more tariffs, retaliation, and watch the economic data as it comes in. This kind of environment can create risks, yeah, but sometimes also unexpected opportunities if you're paying attention.
Which leads us to our final chapter, Chapter 8. Conclusion and forward look. We've covered a lot of ground on this April 2025 tariff shockwave. What are the main takeaways?
I think the biggest takeaway is that this is a really significant move, a major escalation in U.S. trade policy with potentially huge, long-lasting consequences for global trade and investment. The speed, the legal basis, using IEEPA for trade deficits, that's a notable shift.
And the impacts are widespread but uneven.
Definitely. Different sectors, different companies face very different challenges and maybe opportunities. But the overall economic models, they generally point downwards for growth, upwards for inflation. So investors really need to be strategic, adaptable.
Now, earlier you teased a possibly counterintuitive insight about the long-term future. What were you thinking?
Well, it's just a thought, but while these tariffs are clearly causing short-term pain, disruption, costs, could they, maybe inadvertently, speed up trends that were already happening anyway?
Like what?
Like the push to diversify supply chains away from just one or two regions.
Yeah.
Even if it costs more overall, maybe companies accelerate that move for resilience. Or maybe there's a stronger push for domestic production in key strategic areas. Again, maybe costlier, but potentially more secure against future shocks.
So the disruption forces a kind of long-term restructuring.
Possibly. It could lead to a reshaping of global commerce, maybe towards slightly less efficiency but more resilience in ways we can't fully see yet while we're focused on the immediate turmoil. It's just something to consider.
That's definitely a thought-provoking way to frame it as we wrap up this deep dive. It's crystal clear these April 2025 tariffs are a major event, hitting the global economy and investment strategies hard.
Indeed. And it really forces that question.
Ah.
How might this new trade environment fundamentally change the game for global commerce and investment, not just now, but for years down the road? That's the big picture question to keep pondering.